Hi, welcome to a video on inventory accounting. This video will be related to an introduction to the measurement of inventory. So what is inventory? Inventory includes assets of a company that the company intends to either use currently in the production process or the company has in production for future sale or intends to sell in the normal course of business. Used currently in the production of goods to be sold, that's called raw materials. Has in production is work in process, and the finished goods is when the manufacturing is complete. So if you think of, for example, an automobile manufacturer like General Motors, the raw materials are in the motor and the axles and the steering wheel. It's all sitting in bins. Those are raw materials. Once those raw materials are placed onto the production line, they become work in process. And when the car is completed, it's all transferred to finished goods inventory. Inventory is reported on the balance sheet. The inventory amount reported on the balance sheet is the cost of inventory still on hand at the end of the period. The related expense to inventory is cost of goods sold. The amount of cost of goods sold reported on the income statement is the cost of the inventory sold during the period. So you take every unit you sold and we expense what it cost the company to ready that inventory unit for sale. There's two types of inventory: merchandise inventory and manufacturing inventory. Merchandise inventory is primarily going to be finished goods, what we talked about earlier. Goods the company intends to sell in the normal course of business. It's inventory that's in its finished state. Retailers primarily have merchandise inventory. Retailers like Target and Walmart and Home Depot. The cost of merchandise inventory is going to include the purchase price to acquire the good, plus any costs required to get the goods in condition and in the location for sale. Manufacturing inventory is inventory that is, just as it sounds, manufactured. So manufacturing companies produce the inventory that they ultimately sell. Inventory for a manufacturer is going to include all three of the types: raw materials, work in process, and finished goods at the end of every period or at any point in time. Thus, the accounting system will include general ledger accounts for raw materials, work in process, and finished goods, and the costs associated with the good in process will transfer through the accounts. They'll start in raw materials, then they'll be transferred to work in process, and then finished goods to reflect where the good item is in the production state. Direct labor and manufacturing overhead costs are also added to the work in process account as these costs are incurred. This process is shown in an illustration in your book. Now, in this course, we're primarily going to use and examine retail inventory for retailers, inventory in the finished goods state. But we have a whole course devoted primarily to manufacturing companies, and that's the cost accounting course, where we'll develop your expertise accounting for manufacturing company operations, including the production of their inventory. Okay. So let's take a look at what this looks like in the real world. This is the Target balance sheet, and as you can see, at the end of the most recent fiscal year, as of the time this video is being produced, inventory was $11,886,000,000 because the numbers here are shown in millions. Okay. So among the total assets of the company are $55,356,000,000, and about 20% of those assets are the inventory at the midnight on February 3, 2024. Right. Here is the cost of goods sold. So during the year, most recent year completed, which is fiscal 2023, it's the year ended early February 2024, the sales for the company were $105,803,000,000, and the cost for Target to acquire and ready for sale the units sold, like the mops and the books and the clothes and the food, the cost of that was $77,736,000,000. And there's cost of sales. That's the expensing of the inventory asset as the units of inventory are sold. Finally, Target provides a footnote discussion. Now, I will tell you as I read through this, you're going to know what all of this means. We're going to study all of these concepts that you're about to read about. So if it's a new word, stay tuned. If it's a term you're not familiar with, stay tuned. You're going to be an expert on it quite soon. So footnote 9 at Target's financial statements and annual report. The vast majority of our inventory is accounted for under the retail inventory accounting method, put short as RIM, using the last in, first out, stated briefly, LIFO method. Inventory is stated at the lower of LIFO cost or market. What that's saying is that number you see on the balance sheet, that's where every unit, it's the lower of its LIFO cost to Target. You'll learn what LIFO cost means, or the market value. The lower of those two. Inventory cost includes the amount we pay to our suppliers to acquire inventory, freight costs incurred to deliver product to our distribution centers and stores, and import costs. Inventory costs are reduced by vendor income and cash discounts. Distribution center operating costs, including compensation and benefits, are expensed in the period they are incurred. Inventory is also reduced for estimated losses related to shrink and markdowns. Shrink is primarily for Target's operations related to theft of items. The LIFO provision, you're going to learn what that means, is calculated based on inventory levels, markup rates, and internally measured retail price indices. The LIFO provision was $153 million and $132 million as of the end of the last 2 fiscal years, respectively. Again, you're going to learn what that means in this course. Under the retail inventory method, RIM, inventory costs and the resulting gross margins are calculated by applying a cost to retail ratio to the inventory retail value. RIM is an averaging method that has been widely used in the retail inventory due to its practicality. The use of the retail inventory method will result in inventory being valued at the lower of cost or market because permanent markdowns are taken as a reduction of the retail value of the inventory. All right, and we will learn the retail inventory method later in this course. All right, so let's do a really quick, simple, straightforward illustration of inventory. And this is going to use what we call the specific identification method. Specific identification method actually isn't applied very often because it's impractical. It involves, so it's only used by companies that have really small numbers of units in inventory, maybe high-end jewelers, automobile sales business, used car lots. All right. So Steve's Lemons is a used car lot. It opened for business at the beginning of 2024. The following transactions took place in the first month of business. All right. On January 4, the company purchased its first inventory item, a Honda Accord, for $12,000. So now we have one inventory item. Notice that this is being purchased in order to sell it to a customer for more than $12,000 and make a profit. That's why it's called inventory. If we were purchasing it as a car for a salesperson, it would be property, plant, and equipment. But because it's for resale, it's inventory, and so we debit the inventory account for $12,000. 2 days later, we purchased a GM Sierra for $8,000. But this Sierra was not ready for sale. We had to incur some costs to ready it for sale. Specifically, we paid $400 to have it towed to our place of business. And then we paid $1,500 for a transmission that we then installed into this GM Sierra. So the cost of the GM Sierra includes the $8,000 we paid for it, the $400 to get it to our place of business, and the $1,500 inventory item, the transmission that we put in it. Notice this transaction above. This just shows that when we bought the transmission, we put it in our parts inventory, but then quickly transferred it from parts inventory to the inventory cost of the GM Sierra. 2 days later, we purchased a Lexus for $25,000 that is ready for resale. We just think we can sell it for more than $25,000. Specifically, it was a 2017 Lexus. 2 days later, we purchased a Ford Mustang for $11,000. 2 days later, we purchased a Toyota Sequoia for $14,000. That's a 2015 Sequoia for $14,000. And all of that is going into the inventory account with the specific identification of the car that it is, that the account represents. And on the 20th of January, we made our first sale. We sold that Lexus for $30,000 that we had acquired for $25,000. See that above. And so there is the Lexus coming out of inventory and becoming the cost of the good, the car, the automobile sold. All right. So that's the accounting for inventory acquisition in a very simplistic setting. Let's now ask a few questions about this company. Question number 1. Item number 1, requirement number 1 is to record each transaction in the Steve's Lemons General Journal and post to the General Ledger. Okay, so I've got the journal entries up here, so go ahead and make your own General Ledger and post them to the ledger. I won't bore you with that. So the first question I want to ask is, how many units were available for sale during January? And the answer is 5. It's the Honda, the Sierra, the Lexus, the Mustang, and the Sequoia. There were 5 units available for sale. Oh, and by the way, for the heck of it, let's remember that when we talk about inventory, we can talk in both units and dollars. The dollars associated with that are the Honda, $12,000. The Sierra, $9,900. The Lexus, $25,000. The Ford Mustang, $11,000. And the Sequoia, $14,000. Now, if you add that up, the cost of goods available for sale of those 5 units is $71,900. So there are 5 units available for sale during January, and those 5 units have a cost of $71,900. Okay, let's track some of this. Excuse me 1 second while I write something for you. So, available for sale is 5 units, and available for sale is also the cost of those 5 units, $71,900. Available during January. And 2 things might have happened. We sold it, or it's in our ending inventory. Well, so that's the available for sale. Let's continue with our questions. How many units were sold during January? Well, 1 was sold. 1 unit. So that means there better be 4 units in ending inventory, 4 autos, because there's 5 available for sale. We sold 1. We better have 4 left. And the cost of that unit was $25,900. So of the $71,900 total, I'm sorry, 25,000 period, not 25,900. We sold the 25,000, so the cost of the 4 units is going to be the cost of those remaining 4, which is the Honda, $12,000, the Sierra, $9,900, the Mustang, $11,000, and the Sequoia, $14,000. If you add that up, that's $46,900 is the cost of our ending inventory. And so here you have the 5 units. Well, what happened to them? They were available for sale during January. 1 was sold. 4 remain in ending inventory. That's what happened to the 5 units. And then the cost of those, the cost of the 1 sold was $25,000. So the cost of the remaining is $71,900 minus $25,000. And if you do the math, you're going to find that that is $46,900. All right. So how many sold? 1. How many units in ending inventory? 4. And again, I'm just writing here what I wrote on that page that I just took away. What amounts for sales and autos sold will be reported? So sales of the 30,000 that we sold the Lexus for. Cost of goods sold is $25,000, and the gross profit for the company is $5,000. What amount for ending inventory will be reported on the balance sheet? And again, we calculated that earlier. The cost of those 4 units is $46,900. Okay, and that's a real quick look at inventory in its simplest form. Get the answers down. All right. Now let's look at it in a more realistic setting. We'll start that. So let's talk again in general first before we do cases. Types of inventory systems. Perpetual and periodic are the two types. A perpetual inventory system involves the inventory account is continually adjusted for each change in inventory, the purchase of it, the sale of inventory, the return of inventory. They're all recorded real time. It's designed to track inventory quantities and the associated costs from their acquisition to their sale. Physical counts are still conducted at the end of the period. Any differences between perpetual inventory quantity and the actual quantity on hand could be caused by system errors, theft, breakage, or spoilage. We'll talk about all of those concepts. Now, perpetual inventory system, I'll tell you, most companies use them now because of the technologies. And you know these technologies. You see them all the time. There's barcodes. Most companies use the perpetual inventory system now because technology enables it. Barcode technology is the key. Radio frequency identification tags are allowing inventory moves to be recorded automatically as they occur. So that's the next frontier. And I said watch the blockchain closely in the near future for potential use in this setting. I will say this, though. The blockchain's use is being usurped. Its relevance is being usurped by other technologies. So it has lost some momentum, the use of blockchain. And then the other one is the periodic inventory system. The periodic inventory system does not maintain a continual record of inventory quantity or cost during a period. With a perpetual inventory system, if you want to know the number of units we have or the cost at any moment in time during the period, we can look in the ledger and see it. Not so with the periodic inventory system. Purchases during the period are recorded to a purchases account. A purchases account is a temporary account that will be closed to inventory and or cost of goods sold at the end of the period. The quantity of inventory is determined only at the end of the period based on physical count. The balance of the inventory account is updated for purchases and sales that occurred during the year using a year-end adjusting journal entry or a period-end adjusting entry. The cost of goods sold for the period is established in the year-end adjusting entry for an amount that equals the beginning inventory plus purchases minus the ending inventory. Now, that should make sense after you think about it, because the beginning inventory plus purchases, well, what is that? That's the cost of goods available for sale. And it can be in one of two places. It can be sold or ending inventory. Thus, the cost of goods available for sale minus the ending inventory is the cost of the goods sold. Now, some of those costs could have been from theft, breakage, or spoilage. That's the downside of the use of the periodic inventory system. There's two downsides. One, we can't look at the inventory ledger account at any moment in time and see what's there. And also, we're not going to have information to know exact amount of theft, breakage, or spoilage. Okay, that's the types of inventory systems. Let's look at a couple of other small issues. Physical units in inventory, issues that arise. With most companies, the units in inventory are straightforward, but complexities can arise. with some businesses, and it involves what we call goods in transit, either goods on their way from the supplier to the company or from the company to the buyer. We'll talk more about that. Goods on consignment. That means that it might be our inventory, but it's at someone else's place of business up for sale. And then sales returns. We spoke a little about this in the revenue recognition chapter. Let's talk a little bit about goods in transit. When goods are shipped near the end of a period, they might still be on the way when the period ends. So the question is, which party owns these units? Which party reports these units in inventory? The answer depends on the contract terms, and you'll get to know these: FOB shipping point or FOB destination. FOB stands for free on board. With FOB shipping point, if the contract says that it's FOB shipping point, that indicates that the legal title for the inventory passes to the buyer when the seller hands over the goods to the delivery company, the shipping point of the seller. If the contract calls for FOB, free on board destination, legal title passes to the buyer when the goods arrive at the buyer's location. Free on board destination, the destination of the goods. So with FOB shipping point, we recognize the sale and the receivable and the cost of goods sold and the inventory transfer when the units are shipped from our warehouse, from the company's warehouse, the seller's warehouse. If the contract states that the sale is made FOB destination, the sale, receivable, cost of goods sold, and inventory transfer are recognized when the buyer receives the unit and signs the receiving document. That's the goods in transit complexity, small item. You'll learn about that. Goods in consignment. Goods on consignment. Goods on consignment are units. The unit is transferred to the consignee's location for resale. The consignor, the transferor, retains legal title and keeps the inventory in their accounts. The consignee never takes title. If the buyer is found, the consignee sends the selling price, net of commission and approved expenses, to the consignor, and then gives the unit of inventory it never had title to the buyer. And then sales returns. Again, we saw this a little bit. Returned merchandise is placed back in inventory. The sale is reversed. The receivable or cash is reversed. And in the case of cash, given back to the customer. And the cost of goods sold is eliminated. Okay, so those are three issues that arise with physical units in inventory. There is also the transactions affecting the net purchases. You had a preview to this topic, actually, and I think you're gonna remember it a second. Inventory costs includes all expenditures to acquire the inventory and bring it to the desired condition and location for sale or use in the manufacturing process. This is known as the product costs. Costs of acquiring and readying inventory include the purchase price, net of any purchase discounts. Remember that? The freight in borne by the buyer. The freight in borne by the buyer. Might want to put a little dash here. The freight in borne by the buyer. If the buyer has to buy the freight in to get the unit to their, the shipping, it's going to go into the cost of that unit shipped or units shipped. Insurance for goods in transit incurred by the buyer. That means the insurance was on it and it was shipped FOB shipping point, the seller's shipping point. Cost of unloading and unpacking the goods are going to be costs of acquiring and readying inventory for sale, and they're going to be included in inventory, and cost to prepare the inventory for sale or raw material inventory used. Let me give you an example of this. When, let's say that we have a soccer ball for sale, and the university that's buying it wants their university logo on it, and we agree to put the logo on there. That cost to specialize that good for this particular sale will be part of the inventory cost, and then we'll include it in the sales price. And then again, all of these expenditures are expensed as costs of goods sold when the units are sold. Oh, here's something you're used to. Remember, we referred up here to net of purchase discounts? Well, we talked about sales discounts earlier. Here's the inverse. Under the gross method, we record the inventory at its gross, and then if we pay it on time, here it was $210 net 30, so we get 2% off for paying it by the 10th. We only sent them $490, so we took $10 out of inventory. So under the gross method, we record the inventory at its gross price as if we're not going to take advantage of the sales of the purchase discount. But if we don't take advantage, we just then pay the $500 and take it out of the accounts payable. So the key with the gross method is that we record the inventory at gross and just record a reduction in inventory if we take advantage of the purchase discount. That's for dumb companies. That's very expensive financing when that stuff adds up, that 2% over 10 days, 2% off. Or we use remember the net method with sales discounts? Well, it's pretty much the same logic. We assume we're going to take advantage of them. We're only going to pay them $980. If we somehow make a bad mistake and we have to pay them $500, we debit the expense account, purchase discounts lost. Plus expense minus shareholders' equity. All right. And so this was all transactions affecting the net purchases amount. We looked at the purchase price, the freight inborne by the buyer, insurance for goods that are borne by the buyer, cost of unloading and unpacking the inventory items, and cost to prepare that inventory for sale. And then we talked a little bit more about the accounting for those purchase discounts we talked about up here. All right. Let's talk about one more thing before we go to some cases. The cost flow assumptions. Units on hand at the beginning of the period and units purchased during the period are the units available for sale. The cost of the units on hand at the beginning of the period and the cost of the units purchased during the period is the total cost of goods available for sale. So I pointed to two illustrations that are available to you, and they're also, remember the illustration we did earlier. We know the quantity sold, but we may not be sure of the costs associated with the particular units sold. In this instance, dollar amounts must be assigned to the quantity of units sold and the quantity of units remaining in ending inventory. We use cost flow assumptions. And you've seen a few of these. You saw a case on the first cost flow assumption, specific identification. It assigns the cost of the actual units sold. Must be possible to do so in order to choose the specific identification cost flow assumption, and you've already seen your case of how the specific identification method works. It's pretty straightforward. Most companies do not use specific identification. They use FIFO, LIFO, or possibly average cost. FIFO stands for first in, first out. The FIFO method assumes that the units sold were the oldest in inventory. They were the first in. So the units sold was the first in, first out. The LIFO inventory method assumes the units sold were the most recently purchased in inventory. So in the case of LIFO, it's last in, most recently purchased, first out. Let's think about this. Now, let me preface this discussion by saying companies are able to choose among any of these without regard for the physical flow of the inventory. But for purposes of learning this deeply, let's think about when the physical flow is FIFO and when it is LIFO. Let's talk about FIFO first. FIFO is what the grocery store is certainly trying to make happen when it puts the older milk jugs for sale in the front of the shelf. And then the ones that are not as close to expiration date will be further back. That's a FIFO physical inventory flow. Again, the grocery store does not have to choose FIFO, but one could argue certainly in the case of its milk inventory, it's trying to create a FIFO flow. Last in, first out. Here, I used to teach at a university that if we looked out the window, there was this huge coal pile. And so you could see the tractor come and put more coal on the top of the pile, or they would come and take coal off the top of the pile. That was a physical last in, first out flow, where the oldest coal is at the bottom. They did not have to choose. That coal plant did not have to choose the LIFO inventory for its cost flow assumption, but it certainly was by practicality, the physical flow was last in, first out. And then average cost. Average cost assigns the weighted average cost to each unit sold, or each unit available for sale, either sold or in ending inventory. The periodic average cost is the weighted average cost calculated at the end of the period. Then the cost is assigned to all units sold that period. That's the average cost with the periodic system. The average cost flow assumption with the perpetual system, because remember there's two systems choice, periodic or perpetual, and then there's the cost flow assumption. And in this case, we're talking about average cost. Perpetual average cost is a moving average unit cost where a new weighted average is determined after each purchase of inventory. This average is used to cost units sold and units remaining inventory until another purchase is made. We're going to see cases of all of this, friends. And again, factors influencing the cost flow assumption choice, the choice of the cost flow assumption. So a factor influencing the choice of periodic or perpetual is primarily the cost of keeping the records necessary for doing a perpetual inventory system. That's the determinant of whether we're going to choose a perpetual or a periodic inventory system. Now, once we've made that choice, we have to choose which cost flow assumption we're going to choose. The choice could be made to reflect the physical flow, although, as I've emphasized earlier, this is not required, or it could be influenced by income tax considerations or net income considerations. That's the most common reason the choice is made. Something you're going to learn later is there's a LIFO conformity rule for tax purposes. For financial reporting purposes. If the company uses last in, first out assumption for tax, the company must use last in, first out for financial reporting on the balance sheet and the income statement. Okay, so there's a lot of information just to introduce this important topic. Now we'll make it easy. We'll make it easier by working cases, and you'll master these concepts. All right, thank you for your attention. A little longer video than I prefer, but it's an important one. I'll see you in upcoming videos when we apply these concepts.